If you collect Social Security benefits, depend on a pension, receive retirement income from a fixed monthly source, or still have a mortgage balance on your home, the next 30 days could become the most important financial period of your entire year. Yet almost no retired American has been warned about what may happen next. On May 15, 2026, Kevin Warsh officially steps in as the new chairman of the Federal Reserve. The Senate Banking Committee confirmed him on April 20th, following prepared comments entered into the congressional record that received almost no attention from major financial media outlets. Inside those remarks was one phrase repeated twice that has not appeared in official Federal Reserve communication in more than 4 decades. The phrase was financial repression. And the policy structure Warsh outlined in his own language mirrors the same strategy the United States used between 1946 and 1974 to reduce federal debt from 121% of GDP to nearly 30% without ever actually paying off the principal balance. The retirees most exposed are not necessarily those carrying the biggest mortgage debt. The retirees facing the greatest impact are the people who followed the traditional financial advice they were given for decades. Pay your mortgage off early, keep your savings in high-yield bank accounts, and hold long-term bonds inside retirement portfolios. Every one of those decisions becomes a structurally losing position under the framework Warsh just described. Meanwhile, the individuals who own assets they were repeatedly told to eliminate, especially fixed-rate mortgages below 5.5%, become the structural beneficiaries over the next decade. In the next 15 minutes, I am going to explain the 4 exact actions to take immediately, the federal mechanism that effectively erases part of every fixed-rate mortgage in America without requiring a congressional vote, the 3 retirement asset classes that get damaged under this framework and are probably sitting in your accounts right now, and the one financial decision that converts a recoverable situation into a permanent decline in retirement purchasing power. There is also one major part of this framework that even the Wall Street Journal misunderstood in its April commentary. I will explain that later, because the exact way they misunderstood it is the same way many retirees are about to lose money during the next decade. I work as a federal tax accountant. My office specializes in retirement income filings and federal tax planning for retirees who live on fixed monthly income streams. We process around 900 filings each year, and I repeatedly see identical financial patterns across the same demographic groups season after season. The pattern we are discussing today will affect every one of those clients within the next 12 months. Patricia is 72 years old. She lives in a 2-bedroom condo in Cincinnati, Ohio, that she fully paid off in 2015. She receives Social Security income totaling $2,490 each month, along with a modest pension payment. After her husband died, his life insurance proceeds and the sale of a vacation property were placed into one high-yield savings account. On April 30th, the account balance stood at $81,742. Her account currently earns 4.2% annual interest. The headline Consumer Price Index during the same 12-month period measured 3.1%. That sounds acceptable at first glance, but the Consumer Price Index specifically calculated for elderly Americans, measured separately by the Bureau of Labor Statistics to account for higher medical and housing costs, came in at 5.7% during the same period. Patricia's real return after adjusting for the expenses that actually affect her household was negative 1.5%. Last year, she effectively lost about $1,200 in purchasing power. That loss never appeared on her account statement. Her advisor never called her about it. She had no realistic way to understand it unless she personally searched for the alternative inflation data herself. Under Warsh's framework, that negative 1.5% real annual return becomes the policy target for the next decade. The mechanism works like this in simple language. The Federal Reserve and the Treasury Department coordinate efforts to keep nominal interest rates on government debt and insured bank deposits lower than the actual inflation rate. Savers who keep money inside those instruments are mathematically guaranteed to lose purchasing power year after year, while the federal government and anyone holding fixed-rate debt below inflation benefits as the real burden of that debt shrinks over time. This is not speculation. It is the exact same mechanism used from 1946 through 1974. It succeeded. Federal debt dropped from 121% of GDP to approximately 30%. Savers during the 1950s paid the price for it. Patricia's $81,000 sitting in cash is structurally positioned to lose value. She cannot solve the problem by moving to another bank or searching for a slightly higher yield savings account. Every federally insured savings instrument remains subject to the same suppression of nominal interest rates. Escaping the trap requires moving that money into asset categories the framework does not directly target. Robert is 67 years old and lives outside Phoenix, Arizona. He receives Social Security income of $2,013 per month, a small VA disability benefit, and holds a 30-year fixed-rate mortgage from 2021 with a 3.2% rate. His remaining mortgage balance is approximately $140,000. Under traditional financial advice, Robert has been making additional principal payments of $200 every month in order to eliminate the mortgage sooner. Under financial repression, Robert's mortgage becomes the single best financial asset he owns, and every additional principal payment transfers his own purchasing power directly back onto the bank's balance sheet. If inflation averages 5% over the next decade while his mortgage rate stays fixed at 3.2%, the real value of his remaining principal balance falls by nearly $50,000 simply by maintaining the debt and making minimum required payments. The one adjustment Robert needs to make is stopping the accelerated payoff schedule and redirecting those extra monthly payments into another asset category. Joyce is 70 years old and lives in Sarasota, Florida. She sold her larger house in 2024 and placed the entire $240,000 from the sale into a 5-year laddered certificate of deposit structure through her local credit union, paying 4.8% annually. She was told this was the safest and most responsible decision for a recently widowed retiree. Under financial repression, Joyce's CD ladder becomes structurally identical to Patricia's savings account. The difference between the two is liquidity, not real return. Over the next decade, Joyce's $240,000 is projected to lose somewhere between $72,000 and $120,000 in real purchasing power. Under financial repression, traditional safety becomes the riskiest long-term position a retiree can hold. David is 69 years old and lives outside Chicago. He receives Social Security income of $2,010 each month and has approximately $190,000 concentrated in 20-year and 30-year Treasury bonds. His advisor recommended this structure as the safest possible setup for retirement. Under financial repression, long-duration fixed income becomes the asset class that loses the most value. As inflation rises above the bond yield, every coupon payment David receives purchases less and less over time. As the framework continues, the market value of his existing bonds also declines if he ever needs to sell before maturity. The real return on David's bond portfolio is mathematically engineered to fall between -2% and -4% annually over the next decade. Advice that worked for retirees during the 1980s and 1990s, when the financial system operated under a completely different framework, becomes the worst possible guidance under the system now being implemented. The Wall Street Journal commentary published on April 21st interpreted Warsh's Senate testimony as an academic thought exercise. That interpretation was incorrect. The same section was connected to 3 specific implementation steps listed in Section 4 of the prepared remarks that mirror the precise sequence the Federal Reserve used between 1947 and 1951. Those steps included suppressing long-term Treasury yields through coordinated open market operations, modifying commercial bank reserve requirements to discourage excessive cash savings, and using forward guidance to anchor expectations for interest rates remaining below the inflation trend. A Bank for International Settlements paper published in October 2025 by economist Ricardo Reis spans 47 pages and is publicly available at bis.org. It remains the most comprehensive explanation of this sequence currently available. Here is exactly what to do beginning immediately. Step 1. Audit your fixed income exposure. Gather every retirement, bank, and brokerage statement and list the total amount of money you currently hold in cash savings, certificates of deposit, money market funds, short-term Treasury notes, intermediate Treasury notes, long-term Treasury bonds, corporate bonds, and bond mutual funds. Add those numbers together. That figure represents your fixed income exposure. For most retirees in my office's client base, that number ranges from 60% to 90% of total retirement assets. Under financial repression, that entire allocation is structurally designed to lose real value. The audit requires about 15 minutes and costs nothing. Step 2. If you currently hold a fixed-rate mortgage below 5.5%, stop accelerating your payoff schedule, return to making the minimum required payment, and redirect any additional money toward a different asset category. The fixed-rate mortgage becomes the only debt instrument structurally designed to benefit the borrower during financial repression. Every dollar paid above the minimum represents purchasing power voluntarily handed back to the bank. The mortgage interest deduction also grows more valuable in real terms as inflation increases. Step 3. Move part of your fixed income allocation into inflation-indexed instruments. The two main instruments available to retail investors are Series 1 savings bonds, commonly called I-bonds, purchased through Treasury Direct, and Treasury inflation-protected securities, known as TIPS, available through Treasury Direct or standard brokerage accounts. I-bonds adjust their interest rate every 6 months according to the official Consumer Price Index, and their interest is exempt from state and local income taxes. TIPS adjust their principal value semi-annually using the same inflation index. The annual purchase limit for I-bonds is $10,000 electronically per individual, plus an additional $5,000 through a federal tax refund. A retired couple can shift $30,000 annually from low real return savings into inflation-protected instruments subject only to the annual cap. Step 4. Determine whether your pension includes an inflation adjustment. Social Security adjusts automatically and remains statutorily protected under Title II of the United States Code. Most pensions, including the majority of corporate pension plans and many state and local government pensions, are not indexed to inflation. If your pension lacks an adjustment feature, it becomes structurally identical to a long-duration bond. That means Step 3 applies to that exposure as well. Spending 20 minutes on the phone with your pension administrator and asking one question, "Is my benefit adjusted for inflation?" gives you the answer you need. Step 5. Reposition any long-duration fixed income holdings into short-duration instruments or TIPS. Sell long-duration positions inside tax-advantaged accounts first, where capital losses do not create taxable events. Then gradually sell taxable account positions throughout the calendar year to manage capital gains exposure. Reinvest the proceeds into short-duration Treasury notes under 3 years, into I-bonds, or into TIPS depending on the size of the repositioning and your liquidity requirements. This process usually takes around 90 days to complete and may become the single most important portfolio adjustment the average retiree makes during 2026. There is one tax strategy that almost no advisor discusses. Internal Revenue Code Section 135 provides a federal tax exemption on interest earned from Series 1 savings bonds when those bonds are used to pay qualified higher education expenses for the bond holder, a spouse, or a dependent. For retirees with grandchildren nearing college age, this becomes one of the most tax-efficient methods of transferring inflation-protected wealth between generations available to American households. You purchase I-bonds individually or jointly, hold them until your grandchild approaches college age, then redeem them and use the proceeds for qualified tuition and fees. The interest, which under financial repression could reasonably average between 5% and 7% annually during the next decade, remains exempt from federal income tax under Section 135 and is already exempt from state and local taxes. Income phase-outs do apply at higher modified adjusted gross income levels, but for the typical retiree living on Social Security and a moderate pension, the exemption remains fully available. I created a free guide called the Retiree Protection Checklist, available at marcusgraves.kit.com/checklist. It includes the 4-step fixed income audit worksheet, federal lookup links for I-bonds and TIPS through Treasury Direct, a worksheet for calculating the proper repositioning sequence based on your portfolio and tax bracket, 4 specific phone tree paths to reach a Treasury Direct customer service representative in under 12 minutes, and a 1-page printable summary you can share with the person managing your finances. The guide is completely free. There is no upsell attached. The link appears in the description below. If you remember nothing else from this video, remember this. The framework Kevin Warsh described during his April Senate testimony is not new. It is the same framework the United States used to eliminate 2/3 of its World War II debt between 1946 and 1974. The federal balance sheet has become too large to reduce through any other realistic method. Every alternative option, including default, austerity, or hyperinflation, carries political consequences that financial repression avoids. The framework will almost certainly be implemented. The only real question is whether you end up on the winning side or the losing side of the trade. Cash savers, holders of long-duration bonds, and retirees receiving pensions without inflation adjustments are positioned on the losing side by design. Mortgage holders with fixed rates below 5.5%, owners of inflation-indexed instruments, and recipients of inflation-adjusted income are positioned on the winning side by design. The next 30 days represent the opportunity to reposition before the framework officially activates on May 15th. If this video helped you, press the like button, subscribe to the channel, and share this video with one retiree who needs to hear it. If you know a parent, neighbor, or friend making extra mortgage payments, storing cash inside savings accounts, or relying on a pension without inflation protection, send them this link. The next video on this channel explains the 3 Medicare changes taking effect this season, including the one impacting every retiree with a pre-existing cardiac condition. I will see you there.